Hello again, everybody. So in this panel, we are going to discuss the coordinated campaign by large financial institutions to freeze the next generation of financial rails before they scale. We're seeing it on every front: efforts to roll back the open banking rule, an aggressive push to rewrite the Genius Act through regulatory interpretation, and a hardline campaign to shut down stablecoin rewards. These moves aren't isolated, and they serve a single strategic objective: preserve incumbent market power by constraining the technologies that threaten it. Before we get into specifics, let's ground the conversation with quick introductions. We're fortunate to have three of the best operators in the space, people who have been at the front line of these fights, and they're gonna help us understand exactly how the banks are maneuvering and what we can all do to help counter it. So it'd be great if we could go down, and starting with Angelena, briefly state your name and role, please.
Of course. Excited about today's conversation. Thanks so much for having me. My name is Angelena Bradfield, and I'm the head of policy at the Financial Technology Association. We're a trade association that, unsurprisingly, represents some of the biggest fintechs.
Hey, JW Verret. I teach banking and securities law at Scalia Law School. I sit on the Zcash Foundation board, and I fight TradFi in the common letter wars.
And I'm Faryar Shirzad. I'm the Chief Policy Officer at Coinbase.
Awesome, thank you all. Thank you for being here today. So as I discussed in the intro, big banks are executing a coordinated strategy. What would you say is the common thread in their approach, and why is this suddenly becoming a full-scale fight over the future of financial competition? That's a question I pose to all of you. Whoever wants to take it first.
Well, I can start. I think the banks are actually of two minds when it comes to stablecoins, at least. You're seeing enormous adoption in many of the big banks as they're thinking about how to integrate tokenized payments, tokenized value transfer, giving their customers access to crypto products, and then sort of trying to think through how, from on their kind of broker-dealer side of their business, how to position themselves on tokenization. But in Washington, there is this sort of concerted campaign to try to slow adoption. And so at Coinbase, we kind of talk about it as though there's sort of two different sides of a lot of the banks in terms of what they're trying to do from a business perspective, which is a bit more forward-leaning, including partnering with companies like Coinbase. And then on the policy side, which is really very much of an effort to slow adoption. I think policymakers see it through it. The president's been very clear that he wants the US to be the crypto capital of the world. To slow that down, to protect the legacy system, the president was quite clear that he wants to see updated on behalf of the American people. It feels like a losing proposition, but it's sort of a Washington thing that we all have to navigate through it.
I'll just add, maybe from the fintech perspective, it's very similar to the experience that I know you all have had as well. I think there's been a lot of partnerships on one end to help sort of provide innovative products and services through traditional financial institutions in the fintech space, but then secondarily a lot of efforts from a policy perspective to maintain the moat and to ensure that sort of the competitive landscape is favorable and remains favorable to them, regardless of kind of the innovation that's taking place in the marketplace today.
Yeah, I believe long-term there's a lot of partnerships and a lot of friendships across TradFi and DeFi and crypto. But short-term, we've got a war ahead, so I'm prepping for that before we can be friends again. I like the war analogy, so I'll use probably too many of them today. I see the joint trades letter as the best intel for this war about what they're planning. I see a lot of interesting things in there. Look, it starts off as their fight against their attempt to try to say that direct means indirect. Good luck with that. They got some good lawyers, but ultimately that's their argument. Direct means indirect, which is a tough hill to climb. But they've got some creative kind of things they're going to try to do there. I think it's worth really pushing back in the comment letter wars ahead. This isn't just about stablecoin firms and firms really involved there. You can see one of the consistent themes in the joint trades letter that really worries me is a kind of asset-based regulation focus that we've heard from others in the AML space. Juan Zarate is a big fan of this in the AML Patriot Act space. Asset-based regulation rather than intermediary. Look at page 9 of the joint trades letter, where they attack validation as a regulated activity. I don't think folks paid enough attention to that. So two things I want to achieve today. One, this isn't just about stablecoin firms. All y'all need to get involved in the comment letter wars. Join me as I go up that hill, because they're coming after DeFi. They're coming after validators. They want activity-based regulation. They're not going to stop by rewards from my Coinbase account. They're going to look for any way we make money with stablecoins and DeFi and try to stop it. So I got some ideas for how to stop it, but be worried. It is a real fight ahead, so that's my first.
I love it. I'm ready to write a comment letter right now after that.
Let's do it.
And so we're seeing a multi-front strategy. So we have open banking on one front, which is about controlling data, and then Genius and the rewards on the second front, which is about controlling the economics and the incentives. And so Angelena, we'll start with open banking. FTA has been a leader in that space, and it'd be great if you could walk us all through kind of what has happened to date and what will be the implication if you or we are not successful in challenging.
Absolutely happy to. So, just as a bit of a refresher, I think as everybody in this room is aware, open banking is the ability for a consumer to permission the secure sharing of their financial data to a third-party service, whether it be an app or service of their choice. So, from that perspective, it's something that, is sort of included in the Dodd-Frank Act, Section 1033. We've seen sort of a bipartisan effort in favor towards it over the last 5-ish years to get to a final rule. And so last fall, the CFPB actually finalized a rule that really sort of supported this consumer right. However, on the same day, speaking of litigation and interpretation of different elements of the statute, the Bank Policy Institute, on that same day that the rule was finalized, filed a lawsuit raising concerns with various elements of the final rule and sort of how it implemented the statute's provisions. From an FTA perspective, we ultimately petitioned to intervene and was granted our petition to be able to raise sort of, I think, our view that if the banks ultimately succeed here, it will have a severe impact to all of the uses that open banking has today, which is splitting your tab at dinner, paying your friend via Venmo, and most importantly, funding your cryptocurrency wallet. And so, I think from that perspective, maybe two of the areas that I suspect you'll hear us talk more about throughout this panel. One of the interpretations that they believe that they've made with regards to the statute is around the definition of a consumer and representative, and that their view is that it's much more narrow than I think where the industry is at and where we really feel Congress intended it to be. And if they do succeed there, it could have a severe impact in the uses of open banking data today. The second element, of course, is whether fees should be charged. Our view, again, the statute doesn't allow for fees. It doesn't provide that for that, whereas other areas of Dodd-Frank did expressly state that a fee could be charged. And so that's something else that we are continuing to battle against the banks on.
Amazing. And so FTA recently sent a letter that brought together fintechs, crypto firms, community banks, and small businesses. Why do you think such a broad coalition formed around this fight, and what were the messaging that resonated the most with policymakers?
Absolutely. First, I do want to thank the Blockchain Association and so many others for joining us in this. I think it really showcases how existential not getting this right could be, not only for innovation, but also for competition here in the United States. And so from that perspective, we've actually sent three letters, two of which were joint trades letters with this really unique group of individuals that have, I think, really realized what this could mean for the future of consumer permission data. And then secondarily, we also had a letter from 80 plus CEOs also reinforcing how important it is for this administration to get open banking right and to really allow for consumers to access their rights in this way and leverage financial data. So from a message perspective, I do think, really one of the clear indicators that this message was at least heard was with the CFPB agreeing to reopen the CFPB rule. Of course, that comment period recently closed, and we are awaiting next steps from the agency. But it did help move the needle forward, but I think there's a lot more that can be done.
Amazing, thank you. And now shifting over to Genius and the rulemaking process. JW, you mentioned earlier about banks pushing this indirect interest theory that would hand them a regulatory tool to ban stablecoin rewards and block new entrants. And so for those who are not as involved in this fight over the past couple months, it'd be great, Faryar, if you could give some background on what the banks are trying to do in regards to stablecoin rewards in the secondary markets.
Yeah, so the Genius Act creates, as everyone knows here, a federal framework for the issuance of stablecoins. One of the issues that the banks lobbied very hard on, and initially used the community banks as sort of the face of the campaign, was to ban stablecoin issuers from sharing any of the interest that the issuer earns on the reserve assets that they hold backing the stablecoin. I mean, this was a really bitter pill for all of us in this room and the industry to have to swallow, to have issuers limited that way, because fundamentally what stablecoins are ultimately about is empowering a consumer, and part of that empowerment should be the ability for an issuer to share some of the interest income with their customers as they choose. And so there was a compromise ultimately struck, which again was not the right outcome, but it was what it was, and resulted in a ban on the issuers being able to offer interest and yield. What the legislation did not address is whether there would be, and specifically did not enumerate any restrictions on third parties sharing, having any sort of normal rewards program. And these are normal customer incentive programs that we all participate in through our credit cards, through our airline points, what have you. And so as JW was alluding to, the banks have come in and said, oh, wait a minute. They're saying two things. One is the legislation's unclear. The Genius Act, and Congress needs to revisit it in the context of the market structure bill and lock down the ability of distributors or exchanges to provide any sort of rewards program or customer incentive program. And then at the same time, they're going to the OCC and making this very convoluted argument saying somehow rewards or third-party rewards are already captured. I mean, this legally, and JW will talk about this, is kind of a silly argument. I don't think anybody takes it seriously. And there are a lot of comment letters addressing to this, and JW's is actually one of the best comment letters I've ever read that people should take a look at, and we'll get a kick out of, and he'll summarize. But I think the fundamental point is the president wants stablecoins to work. He wants the U.S. stablecoin market to come on shore, and for the U.S. to become the crypto capital of the world. If you have a situation where you have offshore issuers of stablecoins being able to provide an increment of rewards for adoption of their stablecoin at the expense of U.S. issuance, it undermines everything the president's been trying to do. It's hard to see that the administration will go along with that, or Republicans will go along with that, but it's a fight. We are in a war, as JW said, and I think ultimately we're going to win it.
Yeah, JW, it'd be great to get an overview of your comment letter and talk a little bit more about why this is such an extreme departure from the narrow statutory interpretation that banks usually champion.
Yeah, so, and my hope is after this, we have 12 minutes left. Y'all all give me a call. I'll be your outside kind of free lawyer. But let's write a bunch of comment letters. I got a bunch of ideas that aren't going to fit in one. But here's a few tactics to address this issue. So they're trying to say direct means indirect. They're trying to use the definition of affiliate to encompass things that don't encompass affiliate. They're trying to use the history of banking law and definitions and concepts in banking law. They go back to the origins of the OCC in the Civil War, 150 years. I teach banking law. It's a history class, basically. And I got the receipts. You can't just twist on a dime in how you've interpreted that history for all of the Dodd-Frank rulemakings and suddenly be a different person if ABA is a person and BPI is a person. So I have the receipts. And I just found 10 examples where they took the exact opposite view of statutory interpretation and authorization and put them in a comment letter for some good fun, but there are a lot more. And they use this concept of the separation of banking and commerce as like a anchor thing in banking law. It's really not. It's an old idea. Andrew Jackson was a big fan of the idea, but it has changed, morphed completely, especially as a result of Gramm-Leach-Bliley and Dodd-Frank. They use it as a cudgel against competitors, but they hate it too. So they define it in a way that's inconsistent with prior definitions. So just pinning them between two chess moves they want to defend. They don't want a broad statutory power for the banking regulators in the future or in the past, but now they want it this one time. I mean, there's so much fun we can have in comment letters. It's not really strategy. It's just revealing hypocrisy to me. The other one, a couple of others, I like Sun Tzu's strategy of leave a golden bridge behind your enemy, like attack them from the front, show that if you really push forward this idea of validator regulation, we're going to, at least show the regulators, we're going to destroy the AML KYC apparatus with a constitutional challenge. But on the back end, here's a bridge. Just codify the 2019 guidance. Just make clear that disintermediated finance is not captured by the AML KYC apparatus, and you've got a nice retreat there, FinCEN, and I think they'll be interested in that bridge that we built for them. So that's what I'm thinking here, but ultimately, a lot of linguistic gymnastics here that's totally inconsistent with the last 10 letters from ABA under remaining Dodd-Frank guidance and their litigation against CFPB, you just can't say that up is down in that way and get away with it. And I think I want to draw that contrast out even more than we already have.
Yes.
It's worth, Lindsay, it's worth underscoring. Banks at the moment have about $3 trillion in excess reserves sitting at the Fed earning interest. They pay on average, I forget what the number is, something like 40 basis points or something for deposits. And so they're arguing that stablecoins are an existential threat to community bank lending or to public lending. As far as I know, they've never actually produced a study to demonstrate that there's a correlation between stablecoin adoption and bank deposits. We had Charles River Associates, one of the best economic consultant firms, look at the issue. There was no correlation between community bank deposits and stablecoin adoption. And fundamentally, the rewards programs that places like Coinbase and others adopt are intended to use payments for payment purposes. So there's this, the real issue, and I think people who know the sector understand, is that there's about almost $200 billion in payment fees that the banks charge. This is not credit card fees. These are just for institutional transfers. $200 billion. That's a very valuable franchise that stablecoins will threaten, because stablecoins allow you to expedite payments for fractions of a penny and to do it instantaneously. And so there's a significant payment franchise that the banks are worried about that is at the heart of this issue. But the Genius Act was adopted exactly for the purposes of making payments faster, cheaper, and more resilient. In fact, I think for those of you who sort of watch the international space, the G20 a few years back adopted payment objectives that they were hoping, I think by 2035, that something like 40% or 70% of cross-border payments could be executed within an hour at a cost of less than $1 a transfer or something like that. You can do that today with stablecoins. You can hit the G20 payment objectives today with a stablecoin. So the question for the US, and I think internationally ultimately, is do policymakers mean it, and do we actually want the burden of payment fees that technology has now obviated the need for to be embedded by law and stuck on the back of the shoulders of the American people? And the president was very clear that that's not what he wants. And I don't think a lot of kind of clever lawyering in the process can essentially make the case. And then, as JW said, the legal arguments that they're using for a bad policy position don't hold water themselves. So, this issue will resolve itself. It's hard to believe that we're spending as much energy fighting it, but we do what we have to do, and we're taking it quite seriously. And anyone who can get involved should get involved. It's important.
Yeah, and I think on that point, in motivating people to join the comment letter war, I think when some people hear open banking or that this is about Genius implementation, if their business isn't directly tied to that in the immediate moment, it seems like maybe it's not as big of a risk for them. So I think it'd be helpful to hear from you all about kind of what the functional reality would be if the big banks are successful in this push, which they won't be, but just what we're facing here and the magnitude of the issue.
Yeah, they won't be, and they just can't win this. But that also means don't give up the fight. I mean, Jonathan Gould believes in this industry, right? He just showed that with his speech. But let's arm him with everything he needs to defend the OCC in the comment letter process. That's the best thing we can do. It worries me that I see these themes in the joint trades letter, and you can kind of get a sense of what they're thinking going forward. One of those themes is, again, asset-based regulation rather than intermediary-based regulation. They also kind of throw at the wall the idea that everything in, I think they mean DeFi, but everybody touching payment stablecoins needs to comply with CFPB rules. That's an impossibility. I mean, if you think SEC compliance for DeFi is impossible, try CFPB and all the panoply of regulations that they inherited from the FTC. So they are coming after DeFi. I mean, this is not just a fight against the stablecoin world. They've declared war on DeFi in this joint trades letter, and so it deserves some attention. There's also the AML component of this, of course. I don't know who the final boss is. I have some ideas, but the next boss is TradFi, and is the banking trades and Citadel too. We could talk about a different panel. That's what I see going forward.
And Angelena from FTA's perspective.
Sure. I think from an open banking perspective, our view is that if the big banks particularly are successful here, it's going to severely impede your consumer rights. to leverage your financial data as you want. And I think there it can come in many different ways and forms. But I think one of the big arguments that the big banks make now is that what you're seeing in today's environment is the free market at work. But when there are incentives for one entity to hold on to that data and somehow, prevent its provision and its use by the owner, which is you as a customer, then it's really problematic going forward.
Thank you, that's helpful. And so I think as we look to the future, as traditional finance will continue to get more and more involved, there's been discussion around, do we need to have new legal strategies, deeper regulatory engagement, and kind of what that looks like. So I guess, Faryar, from your opinion, what does playing to win against the big banks look like over the next 12 months?
Well, the most powerful thing the industry can do is just to get consumer adoption. We did a kind of an informal survey using Gemini and ChatGPT and Perplexity and the others, and we found there's been about 100 separate stablecoin announcements since the Genius Act was signed into law. So think about it, the legislation has not yet gone into effect, but just since signature, there's been 100 different announcements. Ironically, a number of those announcements have been from the big banks, some of them in partnership with us, but also the credit card companies, payment processors, corporates, others understand that this is the technology of the future that will power value transfer, and I think most companies are smart enough to understand that they need to have a strategy around this. But that adoption will ultimately make these sort of rear guard efforts to defend a status quo that's evolving quickly into a new paradigm more and more ridiculous. And so I think the issue is really for all of us to build products that people begin to use, the adoption to become tangible and real, and people in businesses and at the retail level, and then ultimately these sort of scare tactics like you saw in the New York Times about the dangers of stablecoins or what have you will become sort of seen in perspective at a time when consumers are voting with their feet to adopt this technology for their own purposes.
And JW, from the legal perspective, what are your thoughts over the next 12 months? What can we be doing to push back on the big banks?
I think a torrent of comment letters, strategically informed and aligned, putting big banks in the choice of either you're for regulatory tools that you hate in every other context, or you're not, in which case you're with us, arming OCC with what they need to defend themselves, putting to the extent there are corollary stuff at Treasury that's going to come out, putting FinCEN back in focus to where they were historically, and at CFPB, I don't know, as the agency's kind of being dismantled, though it's hard to dismantle an agency, but certainly being downsized, trying to get this through and your 1033 work through quickly before that happens, and hopefully working with a team there that shares our view. But I think a lot of comment letters. Taking different focuses and flooding the agency is what we do. I mean, Treasury still wants a mixer rule, and they haven't adopted a final one because we push back a lot on that. So I think.
Yeah, just to jump in, the comment letter is a really important idea. The other is sort of grassroots voices speaking up to members of Congress. Stand with Crypto, the grassroots organization, is now at about 2.8 million members. They did an activation on the rewards issue. I think they hit something like 300 to 400,000 emails and letters went into the Senate just on the rewards issue. So the energy behind this is quite significant, but we shouldn't take anything for granted. And the more members of Congress, the staff hear from all of you and others, it's enormous, the impact.
And Angelena, on the open banking front, what can members do to support FTAs? Like I know Blockchain Association has been involved, but if individual member companies are interested, what can they do?
Sure. So I have to sort of double clip on everything that's been said before. I think from an open banking perspective, due to the administration's efforts to shut down the CFPB, we are going to see what the future holds there. It could be, press reports indicate, next steps could be a notice of proposed rulemaking. It could even be an interim final rule. We'll again see what direction they go. But at the end of the day, engagement in explaining, how existential this is to the industry, particularly with regards to the on and off ramps for crypto products and services. Secondarily, really engaging with policymakers across the board, whether that be on Capitol Hill or even, again, with the CFPB, White House, Treasury, others.
Amazing, thank you. And for the two of you, on the work you all have been doing with Genius, is there anything in particular that the members can do outside of comment letters in the next couple months as this battle persists?
I found the secret weapon, the silver bullet that always worked with members of Congress was constituent visits. I think particularly when things were much harder on the Hill, in 2024, 2023, every time we would be able to take a group of founders up, a lot of BA members and others, and take them up to the Hill and sit down with their member of Congress, all of a sudden this abstract crypto thing became tangible and real, and they begin to see that it's not just what they read in the New York Times, it's actually something that people are developing really interesting applications with social utility that solve a conundrum, that help people control their data, control their value, not pay excess fees to intermediaries that they don't need to pay. But all of that requires people in this room standing up and coming to events like this, which thank you for all of you for coming, but then also going over to the Hill and talking to members of Congress, and then supporting Senator Moreno, who's the next on this dais, who's extraordinary in advocating on behalf of all of us, and I think making sure all of you make clear to him how much we appreciate what he's doing will go a long way.
And to paraphrase Churchill, we'll fight him in the comment letters, we'll fight him in the amicus briefs if we have to, and we'll fight him, on your front door, which is, I think, part of the Roman Semenov story, which touches everything we talked about today. And thank you, BA, for continuing to support him. That really means a lot to me.
Amazing. Thank you all so much for the time.